Okay, so picture this. You wake up, you check your portfolio, and a stock you own has lost almost 3/4 of its value overnight. Well, that is exactly what happened with a company called TWG. So today, we're going to dig into the story behind this absolutely catastrophic drop and figure out what on earth went so wrong.
72%. That's the number. In just one single trading day, shares of TWG just plummeted. We're talking about an almost instantaneous wipeout of massive value, leaving investors totally stunned and, scrambling for answers.
So the big question is pretty obvious, right? What happened? A drop this massive is almost never a random fluke. It's usually a symptom of something much, much deeper going on. We're going to peel back the layers here, one by one, and find the real story behind this collapse.
So the thing that immediately sent the stock into a total freefall was a specific announcement from the company. It wasn't a bad earnings report, it wasn't some scandal in the news, it was a direct call for cash. They were asking the public markets for money.
The company announced it was selling 720,000 units. Now, this wasn't just a simple offering of new shares. As you can see, each of these units came with 1 share and 2 warrants. And warrants? Well, they're basically like a coupon. They give the owner the right to buy even more shares down the road at a fixed price. And that little detail, it is absolutely key to understanding the panic that came next.
So a company trying to raise money, that happens all the time, right? So why did the market react with such, extreme panic in this specific case? What made this announcement so toxic for the stock price? Well, it all comes down to one really powerful fear.
And the answer boils down to this critical concept right here: share dilution. The easiest way to think about it is like this. Imagine the company is a pizza. If you own 1 slice out of 8, you own 12.5% of that pizza. But if the company suddenly adds 8 more slices to the pizza, your 1 slice is now a much smaller piece of the whole pie. That's dilution.
And you can see that chain reaction play out right here. Step 1, TWG desperately needed cash. So, step 2, they announced this new offering, packed with both shares and warrants. That immediately sparked fears of massive dilution. Investors saw their piece of the pie shrinking, which led directly to a rush for the exits. Step 4, panic selling.
But here's the thing, right? A healthy company can usually raise money without its stock completely collapsing. That offering, it was just the trigger. The real reason for the crash lies in the sickness that was already eating this company from the inside. It was incredibly fragile to begin with.
Just look at this. In the 12 months leading up to the crash, TWG's revenue, the money it was bringing in, had collapsed by roughly 72%. Isn't that an interesting number? The stock drop almost perfectly mirrored the revenue drop. This wasn't a growing company. It was shrinking, and it was shrinking fast. Now, you might have seen some headlines that the company had recently posted a profit, but this quote here really reveals the illusion. That profit wasn't from selling more stuff, it came from brutally slashing expenses. It's kind of like saying you're saving a bunch of money just because you stopped eating. Sure, it works for a little while, but it's not exactly a sustainable sign of health, is it?
And this might be the most shocking number of all. At the end of the last reporting period, this publicly traded company had less than $5,000 in cash. That's it. That's not enough to cover payroll for even a few employees for a single month. This just screams desperation and explains why they had to make that cash call. They were completely running on fumes.
So when you put it all together, the fundamentals were just a total wreck. The company sells luxury goods like caviar, which is a notoriously volatile market to be in. Their sales were collapsing, their profit margins were shrinking, the whole business model just looked completely unsustainable. That offering wasn't a strategic move for growth. It was a desperate bid for survival.
But a collapse like this, it just doesn't happen in a vacuum. If you were paying attention, you could see a trail of red flags leading right up to this moment. This was a disaster that was literally years in the making.
This timeline really tells the whole story, doesn't it? First, back in July, they get a warning from NASDAQ because their stock price fell below $1. To fix that, a month later, they do a massive 1-for-90 reverse stock split, which is a move of pure financial engineering. And that, of course, brings us to today, this new super dilutive offering. Every single step you see here is just another sign of escalating desperation.
Yeah, and it's really important to understand why that reverse split was such a bad sign. Sure, it artificially boosts the share price to keep the stock listed on the exchange, but it does absolutely nothing to fix the collapsing sales or the cash shortage. For any savvy investor, it's often seen as a company putting on a fancy suit to hide a fatal illness. Okay,
So we've seen the trigger, we've looked at the underlying sickness, and we've followed the history of red flags. But what does all of this mean for someone looking at this stock now? What's the big takeaway from this financial autopsy?
You can really look at a crash stock in one of two ways. Is it a potential turnaround, a great company that's just on sale, or is it what we sometimes call a falling knife, a distressed company that's just going to keep falling? Well, a real turnaround needs a credible plan, a path to making money, and evidence of new sales. TWG, on the other hand, it's showing all the signs of distress, systemic problems with the core business, and a really high risk of even more dilution to come.
So here's the final verdict. That 72% drop, it wasn't the disease. It was just the symptom. This company is facing deep systemic problems, which makes this an incredibly high-risk, speculative situation. Buying into this now is a bet that the entire foundation of the company can be rebuilt from scratch. And it's a bet we have to be fully prepared to lose everything.
And that really leaves us with the ultimate question every investor has to ask when they see a chart that looks like this. Is a massive crash a warning sign to stay far, far away? Or is it a once-in-a-lifetime opportunity? The story of TWG shows us that the answer is never really in the price itself, but in the story behind that price.